Hello and welcome. My name is Brad Crawford. I'm the founder and president of Continental Management Group, and it's my pleasure to have you here today. We're going to talk to you about some important estate planning issues and things that you may want to try and get in place um, before it's actually too late. I hate to say it that way, but unfortunately, in my business, I actually end up meeting with a lot of people that have wished they had done something a little bit beforehand. So we want to make sure that we educate you today and get you started. So we're going to be talking today about trusts, trust versus a will. We're going to talk about a special needs trust. And then we're also going to talk about long-term care. And then we're going to go into a very exciting world for you as with your retirement investments and your retirement savings, and that's self-directed retirement accounts. So let's go ahead and get started. I'm going to go ahead and start our program. And this is, let me get this over onto a fuller page. There we go. All right. So let's talk about the difference between a living trust and a will and what is the difference. So the main difference is, or between wills and living trusts, or that they can include, or what they can include and how they're managed. However, both are key estate planning tools. Are meant to protect and distribute assets to your loved ones. When it comes to using a will and a living trust to protect your assets, understanding the differences between these options can sometimes be overwhelming, and we're here to help you. So let's go ahead and take a deeper dive into wills versus trusts, and let's examine which might be the best certain scenario for you. So a will is a legal document that details your assets. This includes your money, personal property, real estate, and it provides instructions for how you'd like them handled after your death. A will names a beneficiary or beneficiaries to receive your assets, and a trustee who's going to be responsible for distributing them. Depending on the type of will that you're creating, wills can also name guardians for any dependents, designate power of attorney, and name your end of life healthcare decisions should you need to plan for that. Now, a living trust is a trust fund where your assets are held until a predetermined time. So the trust actually owns the assets. As well, it also provides the legal documentation that validates its status as a trust. The assets within it are distributed either upon your death or another date of your choosing. As with a will, a living trust names a beneficiary or beneficiaries and a trustee. However, unlike a will, assets in the trust can be distributed before you die. For example, if you put money or property deeds into a trust account to be given to your child when they turn 21, well, they're going to be able to receive it when they come of age. That's going to be whether you're alive or not. The largest differences between wills and living trusts are what they include and how they're managed. A will is strictly concerned with what happens to your assets after you die, but it doesn't house your assets in the meantime. Now, on the other hand, a living trust holds your assets until a predetermined time and provides instructions for how they're going to be managed and distributed. Now, additionally, and here's the kicker, wills are subject to probate court. So let's just take a little bit of a deeper dive here. This is wills versus trust, a little side by side here. Can it be active while you're still alive? A will? No. Trust? Yes. Do you name beneficiaries? Yes. Is it subject to estate taxes? Yes. Now, the trust is subject to estate taxes unless it's an irrevocable trust. And we can go through that information with you as well if this is something that you want to call us and talk to us a little bit more about. Subject to probate court, a will? Absolutely yes. Typically no with a trust. And I can't really even think of any any idea or any times that I've actually seen it be an issue. Does it need to be notarized? The will absolutely has to be notarized. A trust, not necessarily, but I'm going to recommend, and I always recommend it to my clients, that you get any document such as this, get it notarized. It's just better to do that. Does it need to be witnessed? The will, yes. I would say, in my opinion, even though you have it notarized, that's guaranteeing it's your signature or the signature of you and your spouse. I'm still get a witness. Just just make it one step better. Um, and then can you outline your end of life wishes? No. In the will, you can. In the trust, no. Now, let's talk about a little bit here now about the special needs trust, because I know that this was one of the things that a lot of people have asked us about. And a special needs trust, let's talk about what it is and how it works. So, if you're the parent of a child with special needs, you're aware of the vital role that you play in their medical, social, emotional, and their financial needs. You also know the pivotal yet challenging role that needs based government assistance programs like Medicaid play in your child's immediate and long term welfare. A special needs trust can help you provide financial security to your child after you die without leaving them ineligible for government benefits that they need to obtain care. A special needs trust is a legal arrangement. It's typically set up by a parent or a guardian, and it ensures that assets, often money or life insurance, are held in an account and used to support the child. The funds belong to the trust, not your child. So, therefore, they won't be factored into the child's government benefits eligibility. Special needs trust is intended to supplement the child's government benefits. So let's just wrap this up a little bit here on the trust side. A special needs trust plays an important role in your child's long term well being and offers several benefits. The assets within the trust are not considered when determining eligibility for government programs like supplemental security income and Medicaid. Parents choose the administrator or trustee. The trustees do have fiduciary responsibility, and the assets in a special needs trust can also be used for a variety of other expenses that are not covered by government benefits. This includes out of pocket medical or dental costs, personal caregivers, rehabilitation services, education, even vacations, vehicles, and home repairs and recurring bills. So, if you have a child with special needs, or not, I mean, you give us a call, talk to us about a trust, but especially if you have a child with special needs, you need to give us a call and let's go through your options. All right. I want to move on here. This is a topic that a lot of people really don't want to talk about, but I think it's something that's extremely important. Um, it might be hard to imagine now, but chances are you're going to need some kind of help taking care of yourself later in life. Now, the big question is, how will you pay for it? Buying long term care insurance is one way to prepare. Long term care refers to a host of services that aren't covered by regular health insurance. This includes assistance with routine daily activities like bathing, dressing, or even getting in and out of bed. Considering long term care costs is an important part of any long range financial plan, especially when you're in your 50s and beyond. Waiting until you need care to buy coverage, it's not an option. You're not going to qualify for long term care insurance if you have a debilitating condition. And long term care insurance coverage or carriers, they're not going to improve most applicants over the age of 75. The majority of people with long term care insurance buy it in their mid 50s to mid 60s. Now, again, it's going to depend on your situation, but it's worth having that conversation with a qualified and licensed insurance professional, and we will introduce you to several of them that we work with. Nearly 70% of 65-year-old people will need long-term care services or support, according to 2020 data, which is the latest we have available from the Administration for Community Living, part of the U.S. Department of Health and Human Services. Women typically need care for an average of 3.7 years, while men require it for 2.2 years. Now, I don't know if you've done studies, and I had them on the slides, and I could have shown them what the costs are. Let's just say the costs for long-term care. Just think about if you needed to stay in a nursing home or an assisted living facility. It gets extremely expensive. Or if you have a catastrophic illness and you end up in the hospital with cancer. Cancer's an expensive killer, and it can pretty much wipe out an estate and leave your heirs with nothing. So you definitely want to make sure that this is something that you take a look at. Regular health insurance, it's not going to cover long-term care. Medicare won't come to the rescue either. Medicare, it covers short nursing home stays or maybe limited amounts of home health care when you required skilled nursing or rehab only. Medicare also doesn't pay for custodial care, which includes supervision and help with day-to-day tasks. If you don't have insurance to cover long-term care, you have to pay for it yourself in most states. Some states have some assistance. You can get help through Medicaid, the federal and the state health insurance program for those with low incomes, but that's only after you've exhausted your own savings. So again, it's something that you want to make sure you plan for, and we will talk with you about that as well. Now, we'll move in just a little bit here on what we call a new retirement. And we also pretty much put it out there that this is the way that you can take control. So there's a world of investment options that are at your fingertips. And our goal is to help the average investor increase the earning power of their retirement through a much broader range of investment options and benefits. And these are options and benefits that a lot of people don't even know exist. By using a qualified self-directed account, individuals are provided access to investing in both traditional publicly traded stocks, bonds, mutual funds, and alternative assets. That's everything else allowable by the IRS. We specialize exclusively in the non-traditional to grant access to the alternative investment world. Once your account is funded, there's a world of opportunity at your fingertips. So let's talk about the plans for individuals. These are your traditional IRA, Roth IRA, inherited IRA. We'll go through those obviously when we sit down and talk with you. We also have plans for businesses. This includes an individual 401k plan, also known as a solo K, the SEP IRA, the simple IRA. And we don't really get involved too much in qualified investment and safekeeping plans, but that is something for qualified employers and investors that they can break free from the stock market um, and and kind of take care of things on their own. This is the entire goal of this. And one of the investments, we look at a lot of different ones, but one of the investments we like to talk to people about is real estate. Real estate, as you know, it's not as volatile as the stock market. So if you have money in a 401k, you might be able to turn around and tell them, well, I want to invest this. I want this for growth. I want this for income, or I want this to be, a little bit of a mixture of both. And you can slant it 60 to 40% or however you want to do it. And that's how the money managers that control your 401k, it's how they manage your money. But when you're in a 401k, you're subject to a lot of management fees and stocks on a general basis. You're probably in good shape if it makes about 10, maybe 13% on your money. But every single time there's a transaction, a new stock is traded within the account, there are management fees. And a lot of times those management fees can get eaten up. And if there's a bad year, you lose money. And we all know that a lot of 401ks lost a lot of money in 2008, 2009, and onward. And with the way that the economy is right now, we may be heading in that same direction. So, with a self-directed account, it gives you the option to invest in real estate. There's a lot of other stuff you can do. You can invest in promissory notes. You can invest in uh, S corporations, things like that. So you're in good shape with that. But going back to real estate, you can see this is compound annual returns by year, going back 10 years. And this is what real estate has been able to do. So real estate's a very, very good investment for you. And some of the stuff that we've been looking at with one of our real estate partners and one of our investment firms, we're looking at properties in the Bayview area in Fort Lauderdale. We're also looking in Sailboat Bend. You'll notice right now, and the reason that the market is low as far as housing prices is mainly because there's not a lot of supply. And normally that's exactly the opposite. When there's not a whole lot of supply, is usually, when there's too much demand more than the supply, the prices go up. But right now there's just not a whole lot of supply and there's not a lot of demand. And the reason is because the prices are so low, so people aren't actually selling properties and listing them right now. So Our plan, and we have some partners that are already actually looking at properties and buying them, and sometimes they tear them down and rebuild, and other times they'll go in and they'll do a complete rehab and then flip. But the plan is pretty much to grab a property for cash, hold on to it for 2 to 3 years. The market comes back up, we'll sell the house at a profit, whether we rehabilitated it or we tore it down and built new. But buying and owning real estate, again, it's an investment strategy that can be both satisfying and lucrative. Unlike stock and bond investors, prospective real estate owners can use leverage to buy a property by paying a portion of the total cost up front. Okay. We all know what a mortgage is. Um, we don't have to necessarily do that. This is just, a little bit of a refresher course on how this works. But what makes real estate a very good investment? A good investment has a high chance of success or return on the investment. If your investment involves a high level of risk, that risk should be balanced by that high possibility of reward. And real estate, probably throughout history, has probably been uh, the best tool or avenue for you to increase your wealth. Our plan: identify properties with high profitability for turnover, a 3-year build or rehab, and then we either flip it, we rent it long term, or potentially even Airbnb it, depending on how the Airbnb market uh, turns out with short term rentals and the fights going on with City Hall and county commissions and things like that. So your benefit early on is 6% interest on a 3-year note. Equity, equal equity for the amount of money you have based on how much we end up having in a property, and then an equal profit split upon the sale or upon a rental agreement. So there's other income opportunities there as well. It's really lucrative. We also have some other companies that are available for anyone to look at under no obligation whatsoever. If this is something that you see as a good tool for you moving forward in your retirement, then more power to you. So that's pretty much everything we've got right now in a nutshell. Give us a call today. We're available at 888-784-1944. Promo code Your Life 2023. We'll take care of you. And I want to thank you again. My name is Brad Crawford. I'm president and founder of Continental Management Group. We're here for you. Give us a call and we'll see if we can't help you out and you can take control of your life.